Welcome everyone, another great video. We're going to be talking about the average Canadian retiree in terms of savings, like how much people have saved up for retirement. We'll go through some of the data. And Kevin, let's not keep people in suspense. Let's start right now with some of the numbers from Statistics Canada.
Yeah, I mean, the average Canadian retirement savings. Now, look, first we're dealing with here is an economic family. And I guess before we even start with what the numbers are, what is an economic family? As you can see by the definition below, it's a group of two or more people who live in the same dwelling and are related either by blood, marriage, common law, adoption, et cetera, et cetera. And then they're in these age categories. So, you and your kids under the age of 35, or in today's society, could be 35 to 44. They're still living at home, depending on how it is. But we got to know that it's an economic family. So it could be a husband and wife, anything along those lines. And if we take a look at what the numbers are saying right there, we're dealing with under the private pension assets and then the financial assets. Now, under private pension assets, the big factor to look at is it's an employee-sponsored registered pension plan. We are not dealing with the few defined benefit plans, whether it's a government employee or a few of the actual businesses that are private that still have those scenarios. We're dealing with employee-sponsored registered retirement pension plans in particular. So we had that, we had our RSPs, RIFs, LIFs. As you can see, as the numbers start to go up from 35 all the way to about 64, they are gradually increasing. So you're starting to see that pension assets, you're starting under 35 at that 115. By the time you get to your prime earning just before retirement, that's where you're getting your biggest number. And then you get to retirement as we see at 65 and it's starting to be utilized. So again, 35 all the way up, you're saving. After 65, now you're starting to spend. And then you start getting into the financial assets that are non-pension, right, Clint?
Yeah, so a few details there. The financial assets non-pension. Important to note that includes lots of details. So that could be cash at the bank. That could be a whole lot of different sources. So if you have an emergency fund, and you should have an emergency fund, that would be lumped into this financial assets non-pension category. But that's not really what's used for retirement. So we didn't. I'm just putting that line there so you know it exists. And then I stripped the TFSA out of there. So you might look and say, well, the private pensions, the RSPs, et cetera, and the employer portion, those add up to the private pension tally, which they should. Given a breakdown there of the overall category. Not the case here for the not financial assets, non-pension. So I'm just giving you the total and then highlighting the TFSA. So we're trying to focus on retirement, and not all the assets in that category would be used for retirement. So that's why we put the total, but then highlighted the ones that are more likely to be used for retirement. Also to note, as Kevin mentioned, economic family, it's a household. They have some fancy definition there, but if you think about it as household, you're probably along the right lines. And then kind of the oldest person in the household would be the age to use, how to get the right age category. So if you're the oldest in the household at 45, well, you're in the 45 to 54 category, according to the Statistics Canada table. And then retirement, Kevin, some folks are lucky enough, they have a defined benefit pension plan.
Yes.
Very few these days because they're hard to find, but that's not reflected in these retirement savings, right? So if you have a defined benefit pension plan, that's fantastic. There's definitely value there. It wouldn't be reflected in this kind of savings. They're just looking at the personal cash people are putting aside in these specific plans. Also to note, some folks, they like to buy rental properties or condos or real estate, and they use that or view that as part of like an overall retirement investment strategy. That wouldn't be reflected here either, right? So we just have to understand the context of the tables here so you can make an appropriate comparison. And we're talking about folks in an economic family, kind of a household. Well, we should look at the other side of the coin there, those not in an economic family. So if you want to think household and single, that's probably a pretty good barometer in terms of how they use this, right?
Yeah, and exactly. And again, all you have to do is look at it. When you get a family, there's a whole bunch of people that can be contributed to it, whether that's 2, 3, 4, beyond that. When you start looking at it on a single basis, of course, those numbers are going to be substantially reduced because this is one person and one person only. Everything else remains the same. Now, the other factor that we should stress, this is average Canadian retirement, not median, but average. There's a big difference between how those two are defined, just so that we have that sort of a scenario going there. And as you can see, it basically follows pretty much the same pattern on the way up. 35 straight through to 55, 64. It is interesting to note that the 65 still tends to be higher, and that could be a variety of different things. In the fact of the family household, you could have people that have moved out, you could have kids that have left and things along those lines. Whereas individually, maybe you're not spending as much money because it's only you have to worry about. You're not dealing with a variety of gifting to kids or things along those lines. But there's other aspects to take a look at for why these numbers are where they are. But as you can see, it still has that sort of pattern. You're growing through your one side, and then all of a sudden you start to look at the spending side once you get to that retirement age.
Yeah, and we're going to look at some regional numbers as well. So that was just giving you an idea of kind of on average what are Canadians saving for retirement. Well, let's answer the question whether you're in a household or not in a household. You got both tables there, and a little bit of a regional difference here. Not to overwhelm people with numbers, we kind of just looked at one slice of the pie. We said, all right, household or economic family to use the term, and specifically the age 55 to 64, because for households that tends to be when folks are accumulating the most wealth, right before retirement. That's when tends to be when they're at their highest. We said, okay, for that group, economic family, or what we call households, and for 55 to 64, how does that group vary in savings across Canada? And then it's kind of grouped a little differently. You have all the Atlantic provinces together, you got the Prairie provinces together, and you strip out kind of the most populous provinces, Quebec, Ontario, and BC. And you can see a pretty clear trend there in terms of savings. The big provinces, folks have a little more money set aside than others.
Yeah, I mean, and that's the biggest factor. I mean, if you sort of take a look at it, population base does have a big bearing as to where the average Canadian retirement savings are. Toronto is or should I say, Ontario is our most populous province by quite a bit. They are the largest player, followed by Quebec, followed by the Prairies, where you lump all three together, then British Columbia. So it does seem to take on a regional variance as well, depending on what your population base is as to how much money is being saved. Mm-hmm. And again, the size of the cities there that you may be living in or contribute contributions that way that go forward. So a variety of these things, you'll notice that, where you live has a dependency as to what you're dealing with. And again, that could be dealing with cost of living expenses as well. I mean, it's probably fairly much significant to have a cheaper cost of living in the Prairies than it may be to have it in BC and or Ontario. So those are things that you have to take a look at. But again, this is all average that we're dealing with. Mm-hmm. Doesn't mean that one person's higher than the other. It's just the average that we've seen over Canada in that time frame.
It's a comparison, right? Folks like to get benchmarks. They want to know how they compare. It's a common question we get, so we want to give you some data to answer that. If you have other questions like this one or anything else in retirement, you can visit the link at the bottom there, chatwithclintonkevin.com. It's on our website. Fill in the form, comes right to us. We'll get back to you as fast as we can. We certainly appreciate the interaction. We like the questions, so please do reach out. And what you were just saying there, Kevin, it's an average. It kind of leads to the next part. People think, well, all right, how much should I have to save? And I think that's what people are really getting at when they start asking these comparison questions. How is everyone else doing? How do I stack up compared to them? Maybe they're a little competitive, or more likely, they just want to make sure they're on the right track. And they're looking at what others are doing to gauge their own process. And so if you're asking the question, all right, well, how much should I have saved for my specific? There's a few ways we can help you answer that. I'll pull this one up here, Kevin. First one, this is from National Bank of Canada, nbc.ca. That's where this data comes from. And you can walk us through here because there's some assumptions they made in order to get those multiple of incomes or those benchmarks for how much you should have saved at various ages.
Yeah, I mean, that's the biggest factors is where do you want your savings? So if we're going to deal with it, we have to do a starting point. And our starting point is you're saving 18% of your salary starting at 30, and it's going to a balanced portfolio. Then your plan is to retire at 65. So if we do that, the multiple numbers ahead at 35, you have 1% of your multiple. But by the time you get to 50, all of a sudden you have 4.6 times the multiple of income that you should have saved at that point. And that's by putting the 18% away from the age of 30 going forward. And then, of course, by the time you hit 65, well, now you're 11.3 times your salary. So that would be how you want to get to that point where you're with the average Canadians going forward and making sure that you're having that money supply that you want to deal with when you go through that retirement stage and how much you should be dealing with. And again, this is only one source, as he said. It's from nbc.ca. There are other options to this as to how much you should save and how long you should go, isn't there?
There are a couple. There certainly are a couple, and we're going to get through that. I'm going to hit a couple of the highlights first for this one, though. When you talk about budgeting, how much do I have to put aside? Well, everyone's going to be a little different, but some of the keys there is they're using a percentage of income. So it's not saying put $500 a month away, because that's not going to be right for everyone. It's essentially saying the more you make, the more you should be saving. And that as your salary increases, you actually save more. So you're building that habit of saving, and that how much you need is very much related to how much you spend. So it's a multiple of income, right? If you make $100,000, well, you're gonna have to put more aside to build a bigger pot so you can replicate likely something close to $100,000 in retirement. If you make a little less, well, maybe you spend a little less, so you don't need to save as much to replicate that income in retirement. So that's all kind of working behind the scenes when they're creating these multiples. And you are correct, Kevin. There's a few ways you can look at this. Another one here is from Fidelity. That first one, again, was from NBC. This is from Fidelity. And you can see their assumptions here are a little different than what we just looked at. So the multiples end up being a little different.
Yeah, I mean, now we're looking at a 15 as opposed to an 18% of your annual salary. So, I mean, even that 3%, though it doesn't seem significant, and even though you're starting earlier,
Mhm.
this is taking it over a longer time frame with less money going forward, and your investments are going, half of it's going into stock and on a balanced sort of play before the retirement at 67 to maintain that pre-retirement lifestyle. I mean, one way to sort of look at it is just assume that your savings is an expense. All you're doing is putting money away at 15% of your salary all the time. So that way, if you continue to do that, you can live the lifestyle that you have now when you hit that retirement time frame. You don't want to be one of those people that, oh, I'm not putting any assumption away. I'm just going to spend every dime. That may not work out. You'll be at that 1-to-1 multiple forever if it gets onto that. So putting that 15% away, as we see from here, again, that multiple is needed because as your salary goes up, as Clint mentioned before, it's not a straight specific amount each month, each day, or whatever the case may be each year. You're doing it on a percentage basis on how your income goes from there. So that has a big play, and it all comes down to what you want to deal with. And usually the Becker Orr mantra, which is have a plan. You can't just sit there and say, well, okay, let's see what happens. If you have that plan, if you start that plan early, you should be able to get to that point that you need for that retirement scenario. And each person's a different individual. So that is going to be a plan that's maintained specifically for you. It is an average for a lot of people, but we want to maintain the plan. How's it best suited what your situation is?
Exactly. We're looking at averages for what Canadians have saved, and then we looked at a couple of other ways you could try to use your personal situation to create benchmarks based on those multiples. But as you just mentioned, Kevin, the best bet, have a plan specific for your needs and then use that to provide the benchmark. Hopefully that helps out, answers a couple of questions. If you like this video, you'll probably love the video that's floating on the screen right now about the average Canadian retiree income. Similar concept. Click on that one. We'll see you there. Take care, everyone.